lesson this week. If you look at the syllabus ahead, we don't cover every chapter in the book. Why didn't I leave out the hardest chapter in the book? Because this is the chapter in which time value of money is presented. I want you to know that the big lesson here is time value of money. We've chosen bonds to demonstrate time value of money. Did you understand what I just said? If I throw this out, I harm you, in my opinion. I want you to know about time value of money. I repeat, a bond should sell for the present value of face plus the present value of the interest. We made these calculations in Lecture Monday. We looked in the appendix, found these two factors at the market rate of interest, made the calculation, summed it, and looked in the exercise, and sure enough, that number was in the exercise all along. One of your homework problems for next time is just like that. You need to read the syllabus instructions that say you need to provide a separate sheet of paper to show your calculations for the time value of money, for the sales price of the money. Your format could be much like this one. Let me ask you some conceptual questions about what we determined here. Now, I'm willing to have an individual dialogue with you about how this was done or why we did it that way. But that was supposed to be part of Monday's lecture, and I'm choosing not to do that right this minute, and I've already addressed that. But once we've made these two calculations, could we talk about what we arrived at? Could we talk about what we have here? Tell me about this $97,000.
If you invest $97,999 today, within 10 years, it will worth $260,000.
That's precisely the point I'm trying to make, and I didn't formulate the question very well, but I'm glad that you figured it out. Toby, thank you very much. This problem, we were told we're selling $260,000 worth of bonds. I promise I'm going to pay back the $260,000 someday. The question I'm trying to answer is, what's the present value of that $260,000? And Toby says, because of the calculation that we made, it's about $98,000 here, that $97,991.40. $98,000 invested today will be $260,000 someday. That's because of the time value of money. Money works for you if you'll put it to work. That's a future value. This is a present value. This is today's dollars. Not because of inflation, but because money employed will beget money. We'll have more money someday when we successfully employ that. Now, did you realize that the other part of this calculation, that 20 times we're going to pay $11,700 in interest? And what I want to know is the present value of all those future promises. Would somebody take your calculator and multiply 11,700 by 20 and tell me the total interest I'm going to pay over the life of this bond? Who's got me that number? $234,000 in interest will be paid over the life of this bond. And when I have paid the $234,000, I still owe $260,000. Are you with me? None of this represents a payment of the principal. All of this represents the cost of using somebody else's money. And then I have to pay them the money back. Monday's lecture started with, I promise if you'll loan me money, I'll pay you back. I promise if you loan me money, I'll pay you interest between now and then. Now, what is the $145,000 figure there? $145,807. We're going to call $146,000. What if you were blessed by a grandparent who in their estate provided a trust for you? and that grandparent died and left in trust for you $145,807 to help you get started with college and life, allowed you to withdraw $11,700 every 6 months to just get by on. Can you handle it?
Yes.
6 months from now, you got your, I heard that hearty yes. I can handle it. $11,700. And 6 months later, you got $11,700. And 6 months later, you got $11,700. And so forth. These payments came to you to help you through college, give you some spending money, get your life stable until you could get a job and be self-supporting. I've withdrawn 19 of these so far. I just made my 20th withdrawal. How much have I withdrawn from this fund? Say that number for me again. I withdrew $240,000 from this fund. What is the balance of this trust fund now?
Yeah.
I think I heard the right answer twice.
0.
And the other person that said that over here? 0. There was just enough money. Did you realize that? $145,000 invested now would allow you over time to withdraw a total of $234,000. There's just enough money to do that. Because this money is making money, and because we're using up the principal as well. How about that? $145,000 will give you $234,000 over 10 years in 6-month increments of $11,700 each. The time value of money. Now the sum of these two, the sum of $97,991 and $145,807 is the price at which a bond sells. And I went way in way much more detail than I promised twice I was going to. You needed to hear the recap. Make me an entry to sell these bonds quickly. Toby.
Debit cash for 243799935.
And
Credit bonds payable. And
for $260,000. I thought debits and credits had to equal.
Yeah.
They are? I don't believe so.
They will be.
Not equal to.
When I debit a premium on bonds payable.
Debited or credited?
Debit.
Premium or discount?
I think it's premium.
It's discount.
Discount?
You trust me or not?
It's premium.
Let's vote, class. Is it premium or discount? Everybody that says premium, hold your hand up. Say discount. Premium or discount, Toby?
Discount.
Why? You shouldn't have had to listen to them. They don't have anything to do with it. They don't know.
Hold on. Cash. We're selling it at a.
Did we get more than 260 or less than 260? Face is 260.
Yeah.
Did we get more or less?
Less.
Premium or discount?
Discount.
It's a debit, you said.
Mm-hmm.
Premium's balance is credit. Discount's balance is debit. You're going to debit cash for the amount you receive in cash. You're going to credit bonds payable for face. You owe the whole thing. And you're going to debit premium or discount to make it balance. Premium if you got more than face. Discount if you got less than face. If you're with me right this minute, say yes.
Yes.
Now, that's where our lecture should have ended. Now, I'm 20 minutes into today's lesson. Here we go. Tell me about the 16,200. Tell me about, I'm just going to call it 16,000, okay? It's the 16,200 number there. I have questions for you about it. Do I have to pay back the 16,000? Yes or no? You should know that from Monday's lecture. Yes or no? Do I?
Yes.
You do?
Yes.
I promise I'll pay you back 260,000. Even though you only gave me 243,799, I will pay you back face. I'm going to pay you the whole thing. I have to pay back the 16,000 that you didn't give me up front. Then the question comes, is that 16,000 an expense of the last year only? Do you understand why it's a good question? It's a good question because that's when the payment's really going to be made. Some of us think expenses occur when you pay them. So it's a good question to entertain. Is this an expense of the last year when you pay it only? The answer to which is
No.
no. That 16,000 is an additional expense of every year that you use somebody's money. That 16,000 is increasing your cost. You're not only going to have to pay the 11,700 every 6 months, but at the end you have to pay back 16,000 more than you got. That is increasing your interest cost. The process of spreading that 16,000 over time is called amortization. Say it. Amortization. It's kind of like depreciation. If this were a truck that we were spreading out over time, we'd call it depreciation. If this were oil we're producing, we'd call this depletion. If this were coal, if this were timber, we'd call it depletion. The process of allocating this intangible, this intangible is called amortization. It's a strange word. But it's a process that we've experienced other places. It's reasonable for us to do what we're about to do. I'd like to talk to you about what we're trying to accomplish with amortization. If you think about the calculation that we made, let me refer to that journal entry one more time. Said debit discount for $16,000, credit bonds payable for $260,000. We have well established that we have to pay back the full $260,000. What should the balance of discount be when we're ready to pay off this bond? Zero. There should be no discount. Now, maybe a related definition would help you. I've drawn the parallel between this and depreciation already. Let's think about equipment reduced by accumulated depreciation. Y'all remember the name of that? Equipment minus accumulated depreciation is called, Jeff?
Book value.
That's book value. A lot of times when we combine a main account and a contra account, we get a result that's worth naming. In the same way, we've introduced you to a contra account or a sub account, premium and discount, that are related to bonds payable. In the same way that we're combining to get a net number here, we could do the same thing with these bonds. The balance of bonds payable plus the premium, or the balance of bonds payable minus the discount, yields a number kind of like book value. We call it bond carrying amount or bond carrying value. We'll stick with bond carrying amount. What should bond carrying amount be by the time we reach maturity, by the time we get ready to pay off this bond? Tucker?
The face?
Is correct. Say a number in this problem.
260,000?
By the time we get to the finish line, we want bonds payable to have a $260,000 balance and discount to have zero. The purpose of amortization is to allocate this to each period and to eliminate the balance of premium or discount. There are two broad objectives that we have of amortization. We want to match the right amount of expense with the right year. We have an expense recorded, interest expense, the amount we pay. That's not necessarily the amount we incur. We need to adjust it. If supplies is wrong, we adjust it. If prepaid insurance is wrong, we adjust it. This is not a new process to us. It's just another thing that we adjust to make it right. And to eliminate premium or discount. We've established that already. You told me the balance of discount should be 0 by the time the bond matures. There's two ways to express the second one, and we've experienced it already in the last few seconds. The balance of bond carrying amount should be face by the time the bond matures. Our objective is to get this 243 or whatever it was that we got at the beginning to be 260,000 by the time it matures. That's the amount we owe. That's the amount we have to pay back. It is through the allocation of this additional expense to those periods called amortization that we accomplish that. So, let's talk about the entry that we would make for amortization. I'm going to talk to you about amortizing a premium and amortizing a discount, and I'd like you to hear this series of questions just about amortization alone. Now, if I could have given the whole lecture, if I could have gotten to you on Monday, there's a chance that you might have made these entries that you made in today's homework differently than you made them. I like to talk about the payment of interest and the amortization in separate entries. The book blends them into one entry that I am not afraid to talk about at the end of the week. I just happen to like to do them in separate entries, and we'll do that in a few minutes and you'll see that. I'm just talking about the amortization entry per se. Tell me, class, what is the balance of premium? Is it debit or credit?
Credit.
I need to hear a whole bunch of people say
Credit.
thank you. And the object of amortization is to get rid of premium. How are you going to get rid of it? Debit it. Debit premium. Debit it. Yes, everybody? So, in amortizing a premium, we're going to debit premium by a little fractional part of the amortization we're attempting to accomplish. The other half of an amortization entry is always interest expense. We are trying to match the right amount of expense with the right year. It's always interest expense. Sometimes interest expense is debited, sometimes interest expense is credited. Here's why. They gave me $240-something thousand. I'm going to have to pay them $260,000. This $16,000 they didn't give me that I have to pay back to them increases my interest cost. Amortizing a discount will increase your interest cost, your cost of using somebody else's money. Let's make up an example. What if I borrowed $1.2 million on $1 million worth of bonds? I have to pay back how much? $1 million. They gave me how much? What about the $200,000 extra that they gave me? Do I have to pay that back? Is this a premium or discount? It's a premium. And I've got $200,000 that I can spend on my project that I don't have to pay back. What a sweet deal. What's that going to do to my interest cost? What's that going to do to the investor's yield? It's going to reduce my interest cost, and it's the way we do it in this entry. The other half of the entry is always interest expense. Match the right amount of expense with the right year. Amortization of premium will debit premium to get rid of it, and credit interest expense to reduce the true cost of borrowing. Let's amortize a discount. Class, help me out here. What's the normal balance of discount? Say debit or credit.
Debit.
The object of amortization is to get rid of it. How are we going to get rid of it?
Credit.
We're going to credit it. We're going to credit discount. And debit interest expense. And that's the precise example that I've already gone over that's on the marker board. When we borrowed $260,000 but only got $243,000, or whatever number it was, the $16,000 we didn't get is increasing our interest cost. Do you generally see what we're trying to accomplish? Yes or no? So, these are the amortization increase for premium and discount. The amounts of those increases can be determined in one of two ways. There are two acceptable methods for determining this: the straight line method and the interest method, effective interest method, some people call it. The straight line method may have been in today's homework. Refresh my memory.
Yes.
Because it was the simpler of the two. I didn't want to overwhelm you. The interest method is the better of the two. You need to investigate, be curious enough, read the book, try to find the answer. Why is the interest method preferred over the straight line method? We're going to talk about both, but I'm going to spend more class time on the effective interest method because of what it accomplishes, because it's considered to be superior. Straight line method that you did for today took the balance of premium or discount, whatever it was, and spread it equally over the life of the bond. The same amount every time was recorded as amortization. That's why we call it straight line. It's just like straight line depreciation. It gives the same answer time and time again. Interest method amortization compares two things that deserve to be compared. The amount of interest we pay with the amount of interest we incur. The amount of interest we pay in this particular exercise was determined to be $11,700. 20 times we're going to pay the $11,700. So $11,700 with each payment is in interest expense. That is the face amount times the contract rate. That's the agreement we made when I promised you these things. That's what's in writing. No verbal agreement that we make is going to have an influence on that. It's what's in writing. I will pay you interest at the face amount on the contract rate, the beginning of lecture on Monday. However, is that truly the amount we incurred? So think on these things. The two examples I've used today. I got $243,000. Yet the interest that's in the interest expense account right this minute is based on $260,000. If you had gone to borrow money to buy a car and wanted $15,000 to buy a car, would it be fair for the bank to charge you interest on $18,000? Yes or no? No. They charge you interest on the $15,000 you really borrowed. Look what's happening here. I've really borrowed $243,000. Yet the interest I have recorded in interest expense is based on $260,000. How's that fair? How's that right? How's that for matching on the income statement? Interest expense should be based on the bond carrying amount, not face. And that's why the explanation is here. It should be the market rate of interest. It should be the bond carrying amount on which this is based. And the market amount, the market rate of interest, was because of the sales price that we agreed upon, the deal that we struck, the cash that they decided to give us because our bond was attractive or unattractive. We talked about in Monday's lecture. This is what's in interest expense. This is what we think should be an interest expense. The true amount of interest we've incurred. The difference is the amount of amortization that we'll record for that particular time period. tell me when you catch on to this, and I'll move on to something else. When you record the amortization, it will change the bond carrying amount, which will change the amount of amortization, which will change the bond carrying amount, which will change the amortization, which will change the bond carrying amount, which will change the amortization, which will change the bond carrying amount, which will change the amortization, which will change the bond carrying amount. I think two of you do. I'm not sure the rest of them have it. Do you have it or not?
I don't understand why.
I didn't ask you to understand why. I asked you to understand the mechanics of this will change this, which will change this, which will change this. You got that part?
Yes, I got that.
Just checking. I thought we were going to set the new world's record there for a second. Which is why it's so good to use a chart like the one illustrated in the chapter to accomplish this. You don't have to. I hope by the end of the week I get to work an exercise with you and offer to do it on the marker board without a crutch, without a chart. And I don't expect you to write down all these column names because they're in the book and they're in your note-taking guide. But I'd like for you to see that column A is the equivalent of the left-hand box. It's described as interest paid. In this case, that's $11,700 every time $11,700 goes here. That's the left-hand box. But the true amount of interest expense that we think belongs on the income statement is in the right-hand box, the amount of cash we really have in our hand times the market rate of interest the day we struck the deal, because that's what caused that amount of cash to be exchanged. The market rate of interest times the bond carrying amount is the interest we incur. The difference between these two is amortization and the amount of the journal entry that we want to make. If we can start out with the beginning balance, then this amortization amount will change that. Bond carrying amount will move. As we move down this line, we'll be eliminating discount and getting closer to the bond carrying amount being $260,000 eventually. It's just a little fractional part, step by step. Let's see what we can do to make some journal entries and make the calculations that would demonstrate what I'm describing to you right this minute. The sales price of the bond was debited to cash. Bonds payable was credited with $260,000. Discount was the plug. $16,201 was what it took to make that entry balance. We've covered that already. I would like to amortize the discount. The next item on the list in your handout is on the very back page, I think. It says B1, record the journal entry for the payment of the first semi-annual interest. I think I have a volunteer. She worked ahead like I give her good advice to do, and she has the correct entry. Would you like to tell the class what you did right here?
I debited bond interest expense for
$11,700, like we've been referring to.
and I credited cash for $11,700.
It says the first semi-annual interest payment. We paid cash. We are going to debit interest expense and credit cash. She used the book's correct name, bond interest expense. We've got a bond interest payable. We've got bond this, bond that, bond this.
The name's Bond. James Bond.
Bond, James Bond.
Bond. James Bond.
Name's Bond. James Bond.
My name's Bond. James Bond.
Do y'all know James Bond, the student?
I was just thinking about him.
I need his email address or phone number. One of the puzzles last night on Wheel of Fortune was James Bond. And I took a picture of the screen and I will email it to you. Don't spoil it. Don't tell him.
I have his number.
After class. Okay. This is a pretty full chapter of bond this and bond that, don't you think? So I'm dropping that name, even though you use it in your homework because that's what the problem says is the problem. Okay? Now, I think you can handle the pure payment of interest. If I had set this up by saying, make me an entry to pay the rent, I am convinced that 100% of the people in this room could have debited rent expense and credited cash. Prove me wrong. If you don't know that paying the rent is debit, rent expense, credit, cash, let's talk right after class. Pay the rent, pay interest. Can you feel this one? Pretty simple, huh? Pay interest. Debit, interest, expense, credit, cash. But is that the whole story? Now the handout says, in a separate entry, make me the entry to record amortization of premium or discount. We're dealing with the discount. What's the normal balance of discount, class? Everybody said? The object of amortization is to get rid of the discount. What are you going to do with discount? Debit it or credit it? We're going to credit it. And debit what? An amortization entry is always interest expense. Sometimes it's interest expense debit, sometimes it's interest expense credit, so I never start there. I start with the other half and let the chips fall where they will. Now, the question is, how much? If this were your homework problem and it were straight line, you divide the amount of the discount, 16,201, by the 20 periods over which you're going to amortize it, and you take 1/20th each time. Is this straight line amortization?
Yes.
No. It's interest method amortization. So let's get us a chart, and let's fill in the beginning balance of what we know. There's a place for you to put this in your note-taking guide. The beginning bond carrying amount was the $243,799 we received in cash. That is bonds payable $260 minus this $16,201 figure. Are you with me right now? The amount of one interest payment is, everybody that knows said, mumblers, say it, $11,700. In fact, would it be okay with anybody else if we just went ahead and copied that all the way down through that spreadsheet, yes or no? Y'all with me here? It's going to be $11,700 every time. Now, this column is bond carrying amount times market rate of interest. Get your calculators out. I need help. I want to know $243,799 times the market rate of interest the day we sold the bond. It was 10% annually. In order for us to do this semi-annually, we're going to do 5%. $243,799 times 5%. First hand up. Jeff?
12,190.
12,190 has been suggested. I need some auditors.
That's right.
12,190 is what we think belongs in interest expense. There is already 11,700 in that account. Do I need to make the entry for the whole 12,190? Yes or no? I didn't think I'd stump you on that question. There's already 11,700 in there, and I want the balance to be 12,190. Do I need to make the entry for 12,190? I need to make the entry for the difference in those two numbers, which was, speak up, $490 is the amount of the amortization. I'll come back to that slide in just a second. I wanted you to see this entry that we started just moments ago. You told me the debit and the credit is for $490. Are you with me? Mm-hmm. Now, what did amortizing $490 of discount do to this column? That 16,201 is now greater by 490 or less by 490? Increased or decreased? Decreased. Tell me about this column. Where are we going 20 rows into the future? Thank you. I want to eliminate that. I want that column to be 0 when I finished. Tell me about this column. Where should this column go? As we move down the page, should this number be getting larger or smaller? Larger. To what ultimate number on the 20th row? You are doing a great job on this. Thank you very much. That should be $260,000 ultimately. As we eliminate the discount, we're going to get bond carrying amount to be $260,000 right about the time we get to pay off these bonds. So, give me a new number. 16,201 plus 490 or minus 490? 16,201 minus 490 is 15,711. 243,799 minus 490 or plus 490? Plus 490 is 244,289. While we're here, let's do another row so I don't have to do so much transparency flipping. How about this number? Say it. Thank you. This number. Tell me how to get it. Even if you don't have it, tell me how to get it. Right there.
E times 5%.
Can you say bond carrying amount?
Bond carrying amount.
BCA?
BCA.
I don't need this E stuff. You were right. You're absolutely right. Yes, Nick. E. That's somebody else's formula. 244,289 times contract or market?
No, market.
This is contract. This is market. Market semi-annual is 5%. Nick says, anybody got me this number? 12,214. Is that what you said, Jeff? Yes, class?
Yes.
The difference in these two is the amount of amortization we need to record. Say that number to me if you have it. I was hoping for more than 2 people. This number is 514, and we just keep repeating this. This causes this, that causes this, that causes this, that causes this. Y'all remember that story? That's why you do this chart. And in real life, what you do on this chart is write formulas in each of these cells and copy that 19 more rows down. Sometimes you need a good use for an Excel spreadsheet. Instead of it being taught as a computer lesson, some arbitrary thing that you can't relate to, you need to be, maybe you can't relate to bonds either, but you need an application for that that would serve a purpose for you and you'd understand it better. Did you understand what I just said about write a good formula in each of these cells and copy the whole thing down and not make all those calculations? Let the spreadsheet do it for you. So, what are we going to do with that number? Let's go one more replication here and we'll do it fast. Make me an entry to record the payment of interest at mid-year. July 1st, we paid interest. If you want to do this for me at warp speed, hold your hand up so I know I'm listening to you. At mid-year. Jeff?
For the,
That's a question.
okay. Do I do that one now?
Do you want to?
Yeah, I'll do it.
Go for it.
All right. Debit interest expense and credit cash.
Is a good entry, and that's the one I wish it were. Okay, I like that entry a lot. Here's my least favorite part of the chapter. We sell the bonds January 1st. We pay interest July 1st and January 1st. If we had sold the bonds December 31st, just one day earlier, we would pay the interest June 30th and December 30th and not be having this conversation right now. We sold the bonds January 1st. We're going to pay the interest January 1st. We're going to prepare financial statements December 31st. We have to accrue this interest. It is debit interest expense, not credit cash, credit interest payable, because we're not paying it today. We're saying we owe it today because we're about to prepare a financial statement. Tomorrow, we're going to pay that. That's in your homework. This is my last entry for today. Make me an entry to record amortization for this 6-month period of time. Could we do this as a group? Could you give me big hearty answers, please? Are we amortizing a premium or discount? Discount. What's the normal balance of discount?
Debit.
It's debit. The object of amortization is to get rid of discount. To get rid of discount, you're going to credit it. Credit discount. And debit.
Interest.
It's always
Interest.
it's always interest expense. Sometimes it's debited, sometimes it's credited. We're going to debit interest expense. How much? $514, the amount we saw on the chart that we used to determine that. The best way for you to master this is practice. That's why there's 2 homework problems for next time. Who's better off because you came to class today? Have a nice day.